Hi, and welcome to this episode of the Retire Happy Money Minute. Today, I want to introduce you to Mr. Interest. One of my mentors once explained to me that Mr. Interest can either be your best employee or your worst boss. If you use Mr. Interest as an employee, he works tirelessly. He earns for you day, night, 24/7. And that's the kind of employee you want. Never complains and constantly makes you wealthier. On the other side, if Mr. Interest is your boss, well, relentless, wants you to work for him all the time. In fact, piling work on your desk 24/7, 365, just the opposite of Mr. Interest as an employee. Now, why is this important? Well, you might have noticed that the Federal Reserve had one of the largest increases in interest rates, really in a very long time, and one of the largest ever this past week. So, what does this mean? It means if you're a borrower, a lot of things got more expensive to pay off. And if you're a saver, there's many opportunities that are becoming available to earn a reasonable interest rate again. So, what does this mean for you? Number one, if you're a borrower, you gotta pay off those debts. Now, it's certain kind of debts. We've talked about this before. There's good debt and bad debt. Credit card debt, most credit cards are floating rate, and it's an index plus a margin. So if you are carrying balances on credit cards, those rates are going up pretty rapidly, and I would like to suggest you do everything you possibly can to get those balances down to zero, and then just use the credit cards to the extent you can pay them off each month and avoid those high interest payments. Interest payments on credit cards are as high as 25 or 30%. When they're that high, it means your debt is doubling every few years if you're just making those minimum payments. So if you have to forego a vacation or concert tickets or a night out at a fancy restaurant here and there, I really want to encourage you to do that. But if you've got debt that's locked in, say you bought a car with a 7-year loan about a year ago and you got a 0% interest rate, let it ride. You'd much rather earn some interest on that money than give that money to the bank. Now, the bank wants you to pay those loans off just as fast as you can because they can now turn around and lend it out at a higher rate. Same thing with mortgages. A lot of people want to get rid of that mortgage debt. We've talked about mortgages before. But if you locked in rates of 3, 3.25, 2.5, 2.75, like so many people I know did, as recently as last year, don't accelerate that mortgage. Don't put extra money to it. Put that money where you can earn as much or more without taking big risks. And there's a lot of things crossing my desk today that even on shorter term money of as short as 3 years, we're getting 3.25, 3.5, and even more on insured deposits. So please have that money working for you. Have that money under your control, because one of the things they're also talking about is this increasing interest rate regimen from the Federal Reserve might slow the economy down. Well, it's intended to slow the economy down and by extension slow down inflation. But if we go into recession, you might lose your job. You're certainly going to want that savings at that time. It's not going to do you any good if you've paid down your mortgage, you lose your job, and you have all that money trapped in your house, because the bank's going to say no because you don't have a job to pay it back. So the other side of that is start to build up savings, build up dry powder. Recessions often provide us with the best buying opportunities to make money in the long run. So raise cash, have money available, deploy it at these higher interest rates, and take advantage. There will be great opportunities. There always are. But don't let higher interest rates slow you down on your journey towards a happy retirement. Take care.